Hey everyone, it's Harsh Mittal and welcome back to the channel. Today, we're diving into the exciting world of technical analysis. We'll be covering everything from the fundamental concepts to advanced techniques. So, grab your notebooks, get ready to take some notes, and let's get started. Alright, what technical analysis really is. At its core, it's all about using past market data, primarily price and volume, to try and predict future price movements. We look for patterns and trends in historical price data to gain an edge in the markets. You've got your moving averages, which help you smooth out price action and identify trends, and then there are oscillators like the RSI, which can tell you if a stock is overbought or oversold. And don't forget about chart patterns. The key takeaway here is that technical analysis provides a framework for analyzing market data, but it's up to you to interpret the signals and make informed trading decisions. Moving averages. In essence, a moving average is like a smoothing filter for price data. Imagine looking at a stock chart with all its ups and downs. It can be pretty noisy, right? A moving average helps to cut through that noise by calculating the average price over a specific period, giving you a clearer picture of the overall trend. There are two main types of moving averages, the simple moving average or SMA, and the exponential moving average or EMA. The SMA calculates the average price over a set number of periods, giving equal weight to each data point. The EMA gives more weight to recent price data, making it more sensitive to recent price movements. So, how do you actually use moving averages to make trading decisions? One common strategy is to look for crossovers. For example, you might use a 50-day moving average and a 200-day moving average. When the shorter-term 50-day moving average crosses above the longer-term 200-day moving average, it's often seen as a bullish signal, suggesting that the price is gaining momentum to the upside. Conversely, when the 50-day moving average crosses below the 200-day moving average, it can be interpreted as a bearish signal indicating a potential downtrend. Moving averages are best used in conjunction with other tools and indicators to confirm your trading decisions. Now let's move on to another set of powerful indicators that can take your trading to the next level. Chapter 3. Bollinger Bands and RSI. How to use these indicators. Let's dive into two essential tools, Bollinger Bands and the Relative Strength Index or RSI. These indicators help you gauge volatility and momentum, crucial for informed trading decisions. Bollinger Bands, developed by John Bollinger, measure price volatility. They consist of three lines around a moving average, a middle band and an upper and lower band. The bands widen with high volatility and contract with low volatility. This dynamic nature makes them valuable for traders. One common strategy is to look for Bollinger Band squeezes, indicating low volatility. These squeezes are often followed by increased volatility and potential breakouts. Now, let's move on to the Relative Strength Index, or RSI. This momentum oscillator tells you how strong the current price trend is. Bollinger Bands and RSI are powerful tools to gauge market volatility and identify potential reversals. Chapter 4. Chart patterns, every trader should know. Head and shoulders, double top, etc. Let's move on to one of the most fascinating aspects of technical analysis, chart patterns. These patterns, formed by the price action of a stock or other asset, are like visual clues that can provide insights into the balance between buyers and sellers and potentially signal future price movements. Think of chart patterns like road signs for traders. They provide warnings, confirmations, and opportunities to enter or exit trades based on recurring patterns that have played out countless times in the past. One of the most well-known and reliable chart patterns is the head and shoulders pattern. This pattern, as its name suggests, resembles a head with two shoulders on either side. It's a bearish reversal pattern, meaning that it signals a potential shift from an uptrend to a downtrend. The neckline, which connects the lows between the head and shoulders, acts as a support level. A break below the neckline is often seen as a confirmation of the pattern and a signal to sell. Another common chart pattern is the double top, which, as you might guess, resembles two peaks of roughly equal height. Like the head and shoulders pattern, the double top is also a bearish reversal pattern, signaling a potential trend reversal from bullish to bearish. On the bullish side, we have the inverse head and shoulders and the double bottom patterns, which are simply the inverse of their bearish counterparts. The key to mastering chart patterns is to study them, understand their psychology, and practice identifying them in real time. By understanding and recognizing these patterns, you'll be able to add another layer of confidence to your trading decisions. that wraps up our deep dive into the world of technical analysis. I hope this video has given you a solid foundation and the confidence to start incorporating these powerful tools and techniques into your own trading journey. Remember, technical analysis is a skill that takes time and practice to master. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more trading tips and strategies. And be sure to leave a comment below with your favorite technical analysis tool or any questions you have. Happy trading!